Big week on the economic front with, of course, the Fed's interest rate decision on Wednesday and then the next jobs report on Friday. Let's talk more about the state of the economy with Vanguard Senior International Economist Andrew Patterson. Andrew, thanks for being here. Let's start with the Fed. And I'm curious where you are in the great interest rate increase debate, whether you think the Fed is going to be more aggressive, maybe go 75 basis points or go 50 basis points.
Thank you for having me, Julie. So in terms of Fed policy, we've been becoming increasingly more, I wouldn't say concerned, but increasingly more hawkish as members of the committee have as well. In terms of this week's meeting, we believe 50 basis points is the most likely outcome. Going forward, there could well be another 50 basis point increase in there. Forecasting is a very humbling exercise, forecasting Fed policy equally as much, if not more so. A lot could change between now and the next meeting. So we have to keep an eye on the fundamentals. It's that data dependence message that the Fed continues to put forward, and we believe they will stick to that. That said, they do have quite a bit of wood to chop in terms of bringing inflation down and doing so in an environment where, although growth is slowing, we can talk more about the most recent GDP report. The labor market remains tight. Growth is slowing, but coming down from a very high level, so it remains above trend. So we think that they have some room to maneuver there.
Andrew, we've been talking all morning long about inflation fatigue on the parts of consumers, and just anecdotally, some of the prices I am now starting to see out there for stuff, food, clothing, the past month has been absolutely eye-popping. What would that mean to consumer spending moving forward if consumers just start to really broaden out their level of fatigue?
So I can say from personal experience, I'd say last week was really the first time I did a double take at my grocery bill before I walked out of the store. So certainly this is starting to become an issue for consumers. It's been with us for some time now. We do believe, and we've heard others in the industry talking about this, we do believe that inflation is turning a corner, if you will. So likely to start coming down, again, from very high levels. We're paying very close attention to the month-on-month changes in inflation, maybe more so than year-on-year, and looking at the underlying factors that are continuing to see sustained price increases. Going forward, the Fed is keenly aware of this. They're keenly aware of the fatigue. What they're paying attention to, ourselves included, are inflation expectations, which do remain relatively well anchored now. If those were to continue to trend up, if you start to see that bleeding over into even higher and persistently higher wage growth, that's when the calls for even stronger Fed action are going to start to become louder.
What's interesting to me, though, Andrew, even if inflation is rolling over, I wonder about the historical interplay between it and consumer spending. In other words, if I'm looking at my grocery bill and I've got sticker shock, even if prices don't continue to go up at the same rate, I'm still going to have that sticker shock that's going to linger for a little while. So I wonder if we are still going to have some threat to consumer spending that will linger even if the rate of inflation starts to decrease.
Oh, absolutely. I would imagine that, consumers are going to be making very careful decisions, about spending. You may see that bleed over into things like durable goods. You may start to see that bleed over into some specific sectors. Though, again, I would point back to the idea that the Fed does have some wiggle room, or rather, they're looking at a growth rate that remains above trend. Again, first quarter GDP aside, we believe that was a bit of an aberration, coming in negative as it did, drugged down in large part due to trade inconsistencies and inventory restocking. We think going forward, growth is likely to remain somewhat above trend, though falling, and part of that as a result of consumers paring back spending as a result of increases in prices.
Andrew, by the fourth quarter of this year, what do you see GDP doing? Do you still see it in growth mode?
We see it somewhat above trend, although not as much as we did heading into the year. Heading into the year, we expected GDP growth somewhere north of 4%. Now we've pared that down to somewhere in the mid 3% range. And then in terms of the labor market, again, that's given the Fed a bit of cover. even in an environment of slowing growth, you're going to continue to have a very strong labor market in all likelihood. Unemployment rate there, we believe, is actually going to fall a bit from where we are now to around 3.4%, and inflation hovering somewhere around 4% by year end, which we think is going to continue to give the Fed cover and reason to continue raising rates towards and likely above their estimate of the neutral rate.
Hey, Andrew, you're an international economist, and we've focused our discussion primarily on the U.S. Up until now. But I am curious how you see the international picture because, we have significant deceleration or even outright contraction going on elsewhere as well. So is that going to be, in turn, a threat? Do we still have a global economy where slowdowns elsewhere are going to be threat to the U.S. and vice versa?
Oh, absolutely. The old adage where the U.S. sneezes and the world catches a cold, I think that works very much in reverse as well. Where if Europe, and we're facing some pressures there due to the war in Ukraine, and emerging markets, China chief among those in terms of concerns around zero COVID policy. If the world ex-U.S. sneezes, then the U.S. could very well catch a cold. But again, I would say that even in Europe, our base case is for them to avoid recession. Again, provided how things progress in Ukraine and some of the approaches there. In China, we believe growth is likely to come in below their estimate, although remain reasonably strong, somewhere around 5% on the year. So again, what progresses over the course of the year, we're going to be continuing to pay very close attention to the data, not only here domestically, but also abroad as well.
Well, Andrew, if this inflation continues, we all might be sneezing into one-ply Kleenex. We'll leave it there for now. Andrew Patterson, Vanguard Senior International Economist, thanks so much.